We're back with more of the News Hub here at WSJ Live. I'm Simon Constable. Well, everything you have been told about the U.S. economy is wrong. That is according to Ed Conard. He joins us on the set now, and he's written this book. It's called Unintended Consequences. I have it here. Congratulations, Ed, on your book. I know it's a great achievement to get this out. You've got a lot of things in here that are going to upset a lot of people. So let's get going and start upsetting people. You said that one of the things that's wrong, you're basically saying that bankers weren't predatory lenders taking advantage of homeowners. That's going to strike a lot of people as really wrong. Tell me why you think that.
Sure. Banks went out and found investors to put up the homeowners' down payment, and they did that in the, not to get technical, but the subordinated tranches of securitizations. And so AAA debt, which the banks really are largely held, was over-collateralized by about 20 to 30%, the same amount they would have been with homeowner down payments. We had a 30% drop in real estate prices, and that led institutional investors to withdraw their money from the banking system. And it's really that withdrawal which crippled our banking system, not losses on no money down loans.
So it wasn't predatory lending. Now, what do you say to the idea that maybe the banks knew they could do this because there was an implicit guarantee from the government, not an explicit one, but an implicit that the banks sort of knew that they wouldn't be allowed to fail, and so we ended up, people like me and you who pay taxes, we ended up on the hook for that, and so that recklessness was, is that correct, or is that wrong too?
I frankly think it's a pretty preposterous claim, because if you look at what's happened to many of the management teams and the shareholders of those companies, they've suffered an awful lot of economic damage. But I think you have to differentiate between loan losses and withdrawals. I think that people believe that banks were reckless making loan losses, but in fact the real problem is withdrawals, and that if we hold the banks responsible for withdrawals, they have no choice but to keep the money sitting idle rather than investing it in your house, in your business, etc., and that slows our economy down.
Okay, so this is the idea that there was a massive run on the banks,
sure,
which is just everybody trying to pile in, putting the money in suitcases and running out the door.
Institutional investors, yes.
So the banks were much more stable, though, when they held many more reserves, and you're saying that would slow the economy, but it would make the banking system more stable, wouldn't it?
Certainly more reserves will always make the banking system more stable at the cost of more growth. But the real reserves which make banks stable are the homeowner down payment or the subordinated tranche in a securitization. That's the 20% that really protects the bank, not the little strip of capital adequacy reserves that keep the bank honest and protect the bank after you've eaten through the 20%. You get a 30% drop in real estate, though, and you're going to eat through that 20% quite quickly.
I've got to ask you about imports, exports, but before we get to that, do you think the government has any business choosing winners and losers in terms of companies, like whether General Motors or Chrysler should have survived, or whether Lehman Brothers should have survived or not? Do you think they have any role in that?
Any role, yes. I think you want to do this. You don't want to let short-term dislocations damage the long-term competitiveness of the United States. And so if you can solve problems in the short run that will lead to logical conclusions in the long run, I think you ought to look very carefully at that. But in the long run, absolutely cannot pick the winners and losers.
You don't think that even in the short run that reeks of central planning?
Certainly have to worry about that, always going to worry about political control, but the idea that we're going to let the entire banking system collapse just to hold on to our free market principles seems a little far-fetched to me.
Okay. Now, one of the things that you point out is that if imports reduce employment, and the idea is if we import too much stuff and we have a trade deficit, we hear about this all the time, that that's really bad for jobs here in the U.S. You say, actually, no, the U.S. has grown faster.
Well, I think you have to look in the short run versus the long run. So in the long run, the U.S. has definitely grown fast. So you can't make for $20 what you can buy for $1. That's $19 you're wasting that you could have hired a nurse or a teacher or a truck driver or a waitress. So if you close the borders in the long run, you're going to grow uncompetitive. And we know that the U.S. grew faster than Europe and Japan, who had more closed borders, and was basically at full employment in 2007 prior to the financial crisis. But in the short run, when you have this risk of withdrawals, people wake up and say, we have to leave a lot of money sitting idle. So we have a lot of savings which are not creating employment at the moment. Then if you run a trade deficit, say with the Chinese, who are very risk averse, and they too want to loan money to the United States, but you can't put all the money to work, that will, in the short run, lead to high unemployment. You have to get that money recirculated. So one of the recommendations I do make is that in the short run, we should be tough with the Chinese and say, if you want to have access to our markets in the long run, you have to start buying our goods and not our assets in the short run, because we need to employ people. We can't just let our people sit idle. Well, you buy our assets instead of our goods.
So what about all the U.S. corporations that are sitting on piles of cash that is idle? I mean, presumably that cash isn't doing anything either. How should that be put to work? Do you have a message? I mean, I know corporate America is watching now. If you want to tell them what to do with their money, I'm sure they'll listen and write some checks.
Well, I think that goes back to my first point, which is that you can't hold the banks responsible for withdrawal risk. You have to hold them responsible for default risk. So I make a recommendation that we should quit kidding ourselves that the government is not making guarantees on withdrawals, and that we should charge the banks for those guarantees, and that will reduce the risk of both borrowers and lenders putting that money back to work. Okay. And I make some other proposals that go along with that, but that's the guts of it.
You had some interesting things in the book, and I managed to skim through it. I won't claim to have read it all yet, but I will. Was that sort of science scores on tests really don't have a whole lot to do with how efficient we are as an economy. Can you explain that? Maybe I misread it.
Yeah, well, what the graph shows is that science scores have a lot to do with the efficiency of the economy, but the U.S. is way above their academic test score. So if you look at the productivity of the United States relative to its test scores, it is much more productive than you would expect based on our academic scores, and we use science scores as a measure of that.
Very quickly, 10 seconds, why is that?
I think that the productivity of our most talented people as a result of information technology and the internet and the opportunity set that's available to us is just extraordinary. We've been able to capitalize on that much more successfully than Europe and Japan have.
Oh, great stuff. Thank you very much, Ed Conard.
Simon, thank you for
coming in.
having me.
This is his book, Unintended Consequences, Why Everything You Have Been Taught About the U.S. Economy is Wrong, and you want to check that out. Okay, in the meantime, what do Barack Obama and George W. Bush have in common? Sounds like a joke, but it's not. Jerry Saib is going to explain after the break.